The three big changes to investment taxation that have been introduced this year, the dividend allowance, the personal savings allowance and the reduction to capital gains tax, all have an impact on trustee investment. I'd like to consider them now. Personal savings allowance first. It's important with all of these changes actually to consider the trust that you're dealing with first, and then you can see the impact that the change may or may not have. So the personal savings allowance, which is relevant to interest income, is relevant for the trust if the beneficiary under the trust has an absolute right to that income. So a bare trust, a trust that grants an interest in possession to that beneficiary. In that case, the interest that's received by the trustees will be treated, because it is, as belonging to the beneficiary, and that beneficiary can access the personal savings allowance of £1,000 or £500 depending on their tax rate. How that works mechanically is that the trustees will receive the interest and they will have to pay over tax, deduct tax at the basic rate, pay it out to the individuals. And by the way, remember, institutions will be paying tax without any deduction, will be paying interest, without any deduction of tax for this year onwards. So anyway, the trustees receive that money, pay out basic rate tax on it, pay out the amount to the individual who's entitled to it, and they have to reclaim the basic rate tax. The way around that, it would seem, is to have the interest payer, the bank or building society, mandate the income directly to the beneficiary, because the beneficiary will then receive the income as his, and they can pay it gross, because they will pay it gross to him. They won't have that reclaim FAF, you see. If the trust is a trust where the beneficiary doesn't have the right to income, a discretionary trust, for example, then the income, the interest received by the trust will be taxed on the trust as interest, and the trustees are not entitled to the personal savings allowance. If they decide to pay income out later on to a beneficiary, a discretionary beneficiary, that beneficiary will receive the income with a tax credit of 45%, which the trustees will have to deduct before they pay it out, having already paid tax on the interest at the point of receipt at basic rate, because they'd have received it gross. So the key thing with the personal savings allowance is it's accessible to the individual beneficiary if they're entitled to the income, and not accessible if it's a discretionary trust. So how about the dividend allowance? It's kind of the same thing. If the beneficiary is entitled to the income and the dividends are mandated directly to the beneficiary, they can receive that dividend. Of course, no tax deducted on dividends. They'll receive it and they will be able to access their dividend allowance of £5,000. They'll then pay tax at whatever rate's appropriate above that. If the dividends come via the trustees, even though they're entitled to it, and the trustees haven't mandated that income directly to the beneficiary, then the trustees will have to pay 7.5% on that dividend received. Then they pay it on to the person that's entitled to it, and they'll have to reclaim that 7.5% if the dividend falls within their allowance, and higher rates of tax if the dividend falls above the allowance. So what if the trust is a discretionary trust? Well, in that case, the trustees receive the dividends, they pay their tax rate on it, which unfortunately is not 7.5% because there's no beneficiary entitled to it. It's the highest rate of tax on dividends, which is 38.1%. The trustees, if they decide to pay money out in the form of income from the trust to beneficiaries, will then have to deduct a further amount of tax so that a full 45% is deducted before the beneficiary receives it. They then can use that as a credit and probably reclaim some tax, but not, of course, if they're a 45% taxpayer. So that's how the dividend allowance works for trustees in relation to trusts where beneficiaries are entitled to income and trusts where they aren't. So how about the capital gains tax rate? What about those? Are trustees able to access those? Yes, they are. Of course, they access the rates, but they're also able to access the reduction in the rates, because the rates have come down from 28 to 20% at the highest rate and from 18 to 10. Trustees always pay tax at the highest rate, which was 28 and is now 20. So they get the benefit of that, trustees. If the trust, however, of course, they only have one half of the normal trust, the normal annual exemption from capital gains tax. If the trust, however, is a bare trust, I was talking in relation to that 20% rate in relation to discretionary trust, but if it's a bare trust, a trust where a beneficiary is absolutely entitled to income and capital, then there's a kind of look-through. There always has been, there continues to be. So the capital gain realised by the trustee will be treated as that of the beneficiary. Beneficiary will then be able to access their full CGT allowance exemption if it's available to them, and then pay tax at the rate of capital gains tax that's appropriate to them. 10% as a basic rate taxpayer, 20% as a higher rate taxpayer. All of those factors will need to be taken into account in determining where's the best place for a trustee to invest into an investment bond or directly into collective investments. This is covered in a lot of detail in the Techlink chapter on trustee investment. I would encourage you to go there and give it a good old read.